Welcome to the Real Advisor Podcast. TRAP, TRAP. Please follow us and join in the conversation on Twitter @Advisor Podcast, where you can suggest ideas and themes you'd like the TRAP team to discuss. Also remember to like and subscribe to our YouTube channel and leave a 6 out of 5-star review on iTunes. Doing all this really helps us, which means we can do more to help you. Now let's head over to the studio for the latest pile of TRAP.
Yes, indeed, dear Trappers. Welcome back to what many people are calling episode 79 of the Real Advisor Podcast, TRAP, TRAP. My name is indeed Lick Lincoln, and joining me as ever in the digital studio of Doom are the 3 other horsemen of the apocalypse. 2 of us are in this country, Storyteller and myself. Della Voce is in the USA. Ultra is in South Africa. Gentlemen, give us a quick backstory as to why you are in such far-flung outposts.
Ladies first.
I'm in Florida, in Pensacola, because my daughter is today starting on a scholarship at Pensacola State College. She's studying and playing football, as you guys would know it, soccer as we would know it in Ireland. So it was all a little bit stressful getting here because of student visa issues that we had to go through and jump through hoops and blah, blah, blah. But we are here, and we've been here since Saturday, and she begins a huge adventure today, so best of luck to her. And
Hey Carl, did you have your social media posts reviewed at the border at the arrival? Or did you spend the last weekend deleting them all?
I'm hardly going to comment on anything now.
Okay.
My daughter's opportunities.
Yeah.
Have I, Alan?
Fair enough.
Okay, excellent stuff. And Ultra?
I'm in sunny Cape Town. Yeah, I've got my Humans Under Management South Africa conference tomorrow. So I flew over on Saturday, arrived Sunday morning, so getting everything sorted out and organised for that. But obviously I'm wedded to the cause of TRAP, so I've carved the time out, and I'm on my balcony, actually, on the 34th floor in central Cape Town. This is not a virtual background. You've got Table Mountain and Lion's Head, so yeah, ready to rock and roll. It's good that the time difference is only an hour, so yeah, I think Carl's is a bit worse, shall we say. Yeah, ready to rock and roll.
Okay.
8 o'clock in the morning here, so.
Nice, get out of the way.
Best time of the day. Best time of the day.
Yeah.
Okay, well, without any further ado, let's get this show underway with some more high energy. Is it one read or 2? You always tell me off. I never know.
It doesn't matter, mate.
High energy review is from my very good friend, the Right Honourable Mr. Andrew Usain Hart.
Yeah, we got 2 reviews today. The first one is from is on the Podcast Addict platform, not the Apple platform, which is quite interesting.
It's the best one.
It's a 3-star review though, the review is: Yikes! Successful advisors should be able to afford better equipment. Terrible sound. 3 stars. We'll sort of take that on board. We have been here, there, and everywhere with the sound over the years, and I've got drilling and stuff going on now, so I'm going to try and mute my mic. But we try our best, but onwards we go. The good review, 5 stars from C. Tyndall, is entitled "The Perfect Companion for Long Drives to Client Meetings." Rather than listening to the nagging voices in my head, listening to TRAP has been far better use of my time when on long drives to help people become better, help me become a better financial planner. While I spend my days trying to help clients have money peace of mind, this podcast provides me with clarity and peace of mind that I'm keeping up to date with this great profession. No BS, just 4 experienced experts in their field sharing their wisdom, laughs and stories on what matters in the investing and financial planning world. Nothing else seems to compare. 6 stars. Thank you very much. Back to you, Nicholas.
Lovely. Thank you. Nothing else seems to compare. I think on the sound quality thing, I think actually we're pretty good over. Given that you listen to some podcasts, I think we're okay.
Could be worse. Yeah.
We record from overseas quite a bit of the time as well. So hopefully, if it's a real problem, do let us know, Trappers. But when we listen back, not that I do, but Andrew listens to each episode about 17 or 18 times to get us up the rankings.
19,
I'm sure he would be 19
is.
times. Okay. Right. Well, let's put a timestamp on this episode because we've got a show packed full. Well, absolutely nothing. So let's do some topical tidbits. And we're going to start... make this exciting, Storyteller.
I mention this every year about this time. In fact, it's slightly later this year, but we have got a lot of new listeners in our audience, and they may have missed previous episodes, but the world famous Dimensional Fund Advisors Matrix book has been released for 2025. So I think there's varying degrees of enthusiasm for this piece of collateral. It's very useful, I think. Andrew, I know, likes it because he's a geek and he likes getting into the weeds of the data and the numbers. Obviously, link to it in the show notes. You don't necessarily, I don't believe, have to have an existing relationship with Dimensional. There's a PDF version which you can download, but if you want to really get into it and get the hard copy of it, I know a number of advisors use this as part of their sort of client presentation material, annual planning meetings. I guess it depends on your client, if they are one who likes the data and the detail. And there's quite a lot of sort of backup support for this. There's a great video by friend of the podcast, friend of all of ours to one degree or another, David Swanwick, the Aussie Swanee, who's I think he's the best presenter I've ever seen. Super, super professional, and he delivers.
Agree. Strong agree.
Yeah, he's brilliant. And anyway, he delivers how advisors can best utilize this piece of kit, this collateral. And as I say, it's not for everyone, but for those for whom it is, and for those clients who are quite interested in this stuff, it really is. It really is good. And it helps articulate and explain what it is we do and the power of evidence-based investing. So there is a link to it in the show notes. Get in touch with your local Dimensional contact and learn more about it. I think it's great. Any thoughts, Andrew? Do you look at it? Do you update yourself when it comes out?
There's a lot of police sirens in the background at the moment, so I'll keep my response.
They're finally coming for you.
Very, very, yeah. It's absolutely amazing. You're right. It's information overload when it comes to investing, historical data, compounded returns over multi-decades, even over 100 years, I think, for the S&P. So yeah, it's brilliant. Get your hands on it. I think you might have to have a relationship with DFA Dimensional, but maybe not anyway. So yeah, it's brilliant. I think, Carl, you always have a bit of an issue with them bringing it out too late in the year, don't you? Or have you moved on from that bugbear?
No, it's great. I used to only use one page when I was sitting in front of clients, and it was they have one page where it's like the expected or the actual returns for portfolios for like 40, 60, 60, 40, 80, 20, 100.
Yeah.
And it's like blends. 1, 3, 5. And then they do the lowest return in any 1 year. And I used to use it to basically say, look, here's what you can expect over the long term, but here's the lowest 1 year drawdown. Are you happy that, you're not going to panic and ditch this investment strategy if that happens, because it will happen again, and using that kind of language, it used to definitely, or still does help, because when there are drawdowns, we do get calls, but we don't get as many as probably some of the other firms do, or as we used to do, for sure. So yeah, definitely it's good. I just can't understand why it's like out in September. Like, for a firm with 800 billion under management, would you not put the resources? If you guys are saying that this is like, the Holy Bible for investing, would you not put the resources into getting this out faster? Sorry.
I reckon they should release it by end of January. End of January, yeah. Then we're all ready for it. Now it's like, yeah, it's a bit too late in the year. But the numbers don't change that much, as we know, because it's just a small increment at this point here. But yeah,
but they do. If there is sharp movements in a particular year, downwards or upwards, it becomes very quickly obsolete. So that's kind of my bugbear about it.
Okay, good stuff. Waj, sticking with you.
Yeah.
The 60-40 is... Have you got the show notes in front of you, by the way? Or am I going to prompt you?
You're going to have to prompt me.
Right, the 60-40 is dead.
But that's not because I'm in Florida. That's because it's just...
That's because you're...
This is an article by a guy from Elkstone called Carl Rogers, and he was writing in the Business Post. He didn't say the 60-40. That was my headline. He's basically saying that... private markets should form part of investor portfolios going forward. Now, I don't disagree with No. To be fair, right? I don't disagree with everything. He says in his article, but some of the things. So first of all, Elkstone have been on record saying that they believe pension funds in Ireland should be used to invest in private markets and kind of replace VC and that kind of stuff. And interestingly, there seems to be more voices on that front because ACT venture capitalists were out last week or the week before saying exactly the same thing. So they're pushing the government here to, open up normal Joe Blogs pension funds to private markets, because that I guess that's a little bit like, can you open it up to Bitcoin? That's an easy an easy door to push through, because you can sell sexy stories around private markets, around cryptocurrency, etc. But the article goes on to basically, he says that, the market drop in, sorry, let me know if I'm fiddling with my microphone too much so we don't get any more complaints. The market drop in 2022 basically showed that the traditional 60-40 portfolio is dead. And I was like, but if you stuck with your 64 portfolio, okay, the bond part of it, yeah, I get it hasn't done well, but you'd be back up and making a lot of money since. So I'm not sure that's a perfect argument, but I guess he's trying to make the argument to, kind of sway people towards maybe private equity, etc. He also used the example of, sorry, Nick, go on. Did you raise your hand there?
He's got something to sell, hasn't he? He's got something to sell that's not in a 60-40. So, what's going to put food on the table is slagging off 60-40. I mean,
okay, but you could say exactly the same about me, that I'm selling 60-40 portfolios, 80-20 portfolios, 100%. And so you can say the exact same, to be fair, right? There are a couple of things that he definitely points out, that it's tricky with valuations, how you don't know if one is going pear-shaped until it goes pear-shaped. Liquidity is obviously an issue. He doesn't talk necessarily about the long-term nature, the 7 to 10 years. He does use, though, an example of Yale. So Yale went into private markets a decade or more ago, and that they've seen significant outperformance. He doesn't say outperformance versus what, but he does mention it. And I haven't checked his facts here, but we all know there are lots of other Ivy League universities who have done this also and gone into absolute return and all this kind of stuff, and they have significantly underperformed, 100% equity. So, he goes on then to say that, family offices are in private markets, and so my challenge with this is, okay. My I don't disagree that for the very high net worth investor, that they're going to be, number one, interested in it. They might want to dabble in it, and it's, it might be relevant to them. But for the people the normal folks, and like normal folks are, for me, it doesn't really matter, because it depends on how much you're spending each year. But if you wanted me to put a number on, it's 5 million or less, right? This is difficult stuff to get involved in, because you can't. It's like buying a house. You can't, sell a window out of a house. You can sell part of your private equity fund. If it's illiquid, it's illiquid. Mm-hmm. And the long-term nature of it, we all know the challenge of convincing clients to stay long-term in their investment funds. That's going to be tricky. And then, valuations can be like, oh, it's going great. And then all of a sudden, so people actually have no insight as to how this thing is going. So therefore, forward planning, if it's a core part of what you need into your third act, into your retirement, then it's going to be very difficult to plan, because you don't know what the numbers are going to transpire. So look, I just think it's an interesting space. There's a lot of talk around it. Do I think that, private markets, private equity and cryptocurrency will form part of portfolios in 5 years' time, in 10 years' time? I do. Is access to them a little bit difficult at the moment? It certainly is. But I've been on record saying this. I do think that will open up. So, so look, it's interesting. It's a pretty long article, actually. And well written, I would say. And he makes some fair points, but there's some I would challenge for sure.
Okay, thank you. Let's lead quickly on to the next point then, because that storytelling, and I read this thing this fund that Hargreaves Lansdown is launching. I'm rolling my eyes here, dear Trappers. If you can,
yeah, exactly. So I saw this go on the docket, Carl, when you published it. To be fair, it's a subject we brought up loads of times in the past, as you know. Our Chancellor in the UK, Rachel Reeves, that's her name, isn't it? Almost forgot. She's been very sort of prominent in getting particularly pension funds, large sort of employee corporate pension funds involved in this. And there's always an ulterior motive, really, isn't there? I mean, the way I see these things is a solution to a problem that doesn't exist, fundamentally. And it's a kind of, there's loads of issues around it. It's a real opportunity for various organizations to gather assets and to build fees out of it. There's, I read someone the other day talking about volatility laundering, effectively, because these funds aren't daily priced. They are not marked to market. They decide when they price it, and so often they're quarterly, sometimes even less than that. So they decide the underlying. So it looks like they're quite safe and stable. But yeah, I just noticed, because you raised it and just happened to be in the FT this morning when I looked at it, that the largest retail fund platform in the UK, Hargreaves Lansdown, have just announced they are launching one of these funds and unleashing it on an unsuspecting public. Yes, I think you've got to have to self-select that you are a sophisticated investor, but it's a fund that's managed by Schroders private equity, or one division of Schroders. I had a quick look at the fund. Give you an idea, the annual fee to manage the fund is 3.24%. 3.24%. I'm going to suggest as well that there's probably a lot of other hidden, undisclosed fees in there as well. I think it's going to be north of 4% a year. That's your first hurdle rate to beat public market investing, global equities, S&P, whatever. There's also a 5% redemption fee, which, if I read that correctly, that's you want your money out, you got to give up 5% to get the money back to create the liquidity. There's also, in order to keep liquidity in this fund, their targets have 20% held in cash. Now that's a hell of a drag on your investment returns.
Adorable
to get that out. So, and the other thing, this particular fund launched October last year, so it's just under a year. Total returns to date for those who've been fully invested, just over 3%. Compare that to the equivalent public market, global equities, S&P, whatever you want to call it, significant underperformance. I got to say, I'm a big fan actually of Hargreaves Lansdown in terms of all the tools they've got, the kind of free stuff they've got online.
Yeah.
I don't think they cover themselves in glory. I mean, they are still, I think, holding some blame for the whole Woodford fiasco, and that was a lot about liquidity, etc. They promoted the hell out of it.
You hold them to the same standard that we hold the platforms we use. It's a sales business. Hargreaves Lansdown is just a pure sales business.
It's a sales business. They know this is of interest to some people, so they'll just get it on their platform and allow people to. And of course, it's not advice, so people will self-choose it, self-select it. Those who don't wish to pay for an advisor, the vast majority of advisors wouldn't go near this with the data I've just quoted.
Yeah, and Alan, it's interesting because you need to be a professional investor to get into some of these funds. But by creating these fund of funds, that gets around that professional investor. You now become quite, so basically every single person can invest in this. And it is a sexier story that I'm investing in this, that, and the other. And like when these guys are all talking about it, who's the number one company that people talk about in terms of private markets? It's Stripe, right? Because it's a massive, massive company. Well, there's a million of other companies. There's not a million. There's tons of other companies that have failed for the one that has absolutely shot the lights out. And then the other. My final point on this is, the really good ones get hoovered up by some of the big boys. So like Google have hoovered up, I think,
hundreds of firms.
Yeah, and I think
all the Sequoia Capital, all the big VC firms are already. This is also known as dumping on retail. They can't get rid of this stuff, and they dump on retail. Retail punters come along who know no better. That's what it's known as. It's just not to be recommended.
Alan, just on the fees of that HL fund you mentioned. Redemptions are capped at 5% of the net asset value of the fund, not your charge 5%. As in, they're not going to redeem more than 5% of the net asset values of the fund. A technical point, but does that make sense?
Not sure about that. Okay. Read the comments in the FT article after that. There's a lot of what seem to be
because the comment section is where all the wisdom is.
Can we save this for our redemption fee offshoot podcast? Thanks. Okay.
Slate, not docket.
Done. I mean, dear Trappers, we do come back to this every episode currently, and the reason we do that is because we're passionate about doing the right thing for our clients, and this is a thing. And I think all four of us know, and I'm sure many Trappists know, that we'll be looking back on this in 10, 15, 20 years' time and thinking, what the F were we doing? This was, we could see this was, we were walking through a disaster with this, and I've got really strong feelings it's going to pan out that way as well. Okay, Ultra. Oh, God, go on.
Don't say make this interesting, Nick. You know, we were talking about the dull world of personal finance and money. We try our best, but there's been a new consolidator launch called Absolute Financial Group. I read this in the Professional Advisor. The two people that are running this, the CEO is a guy called David Carter, who I don't know, not aware of, but he's also got involved with someone who I am very aware of called Paul Hogarth, who's one of the OGs of the financial advice world. He runs a company called Tatton and Perspective Financial Group. So they are now actively buying firms. They set up a new consolidator. What was interesting, I read in the article, is one of the main reasons they're doing this, or a contributing factor. Tatton, who run an MPS, they've got 1,100 firms that use their services. And what they've found is when a firm that's using their services is bought, they're being told to move their investment assets away from Tatton. So Tatton thought, let's be on the front foot here. Let's set up a mechanism to buy firms. Then we can buy the firms, help them grow, and they can still use our investment solutions. It's a little bit like Pepsi owns something like 50,000 restaurants around the world. They buy the restaurants because they can then control the pipes, as in the Pepsi being shot through it, and then they don't start selling Coke. So, interesting. Paul Hogarth is a serious player, and I think he can probably do this quite well. So, it's again connected to the consolidator space. So to buying the companies to protect the investment offering.
We'll be talking a bit more about that later on. It's an interesting concept for sure.
Okay, well, given that we are going to talk about that one, let's move on to the next point then. So, SJP's charging structure, which to me still, I struggle to get my head around it. But structure, maybe you've seen through it.
James Mousley, who's an advisor that a few of us know, he posted something on LinkedIn when this was announced last week. Quite interesting, a bit of a deep dive into the new charging structure. Obviously, this is of interest. SJP remain by some margin the largest firm of its type, wealth manager, financial planning business in the UK. So what it does is of interest to all of us. They've come under, as we know, tons of pressure for years, really, about their pricing model. Going through a hell of a huge transition. We're hearing, all of us here, all sorts of sort of conversations about various advisors there and some of the challenges that some of them are going through. But it's a bit of a kind of restructure of the whole organization, it seems to me, looking on. And part of that is a brand new fee model charging structure. And so everyone's quite interested in this. They came in for a lot of flack because of this kind of exit penalty thing they did. You invest in pensions and bonds, and if you choose to appoint a new advisor or move your funds away, then you're going to have an exit charge from the first 6 years. So they've done away with that now, it seems, and what they've done is, and it's probably fair and reasonable, they've done what all of us do, which is kind of unpack the various components, i.e. you pay a certain amount for advice, you pay a certain amount for the product and the wrapper, and you pay a certain amount for the actual investment management. I mean, it's still kind of, structured. I was just looking at it now. The first 250,000 initial advice charge, 3%, and it scales down. The next 250 amounts over 500,000, 1%. And the ongoing charges is quite an interesting one. The ongoing charges for advice are 0.8%. Now, I happen to know that advisors don't retain all of that. For advisors, they used to get 0.5% as their fee ongoing for the advice that they deliver. They've had a microscopic uplift to that. They now retain 0.55%, so a pay rise of 0.05%. And SJP keep the rest.
10%.
Yeah, 10%.
Yeah. That's okay. 10% of the fee, but the client is charged. The client is charged 0.8% for advice. Then separate product charges, 0.35% for pensions and investment bonds, a bit less for unit trusts. ISAs, and then the fund charge. And there was a bit of to and fro on this. Obviously, anyone posts anything about SJP online or LinkedIn, it gets a hell of a lot of traction. So, but the ballpark is they're about 2% ongoing, all in. So you think the lower? No. If you take in, it depends what fund you use, of course. They do have some pretty low cost funds, but the bulk of them, the kind of managed fund where a lot of people end up in, or versions of that, about 0.65, and then you've got the kind of the dealing charge, the trading costs, which in one example I looked at was another 0.6. So yeah, about 2, maybe just a shade under 2%. So where does that sit? That's, I mean, not that price is everything by any means, but just trying to position where they are, because they, we can all compare ourselves to them.
They're
you
a
put
lot
them
lower
in
than
the
that, Alan.
medium to high price right now. They're not.
Alan,
they're certainly not the most expensive, but
on that link you sent, Alan, there's a download PDF that breaks it down in an insane amount of detail. It's very transparent.
Yes, I read it.
No, the PDF.
Yeah.
The PDF has got all the total fees. Most are way under 2%.
If you really want to do a proper analysis, there's another. You've got to then download another link, which is dealing costs, which, as I say, rate depends on what they are, but in some of them, the kind of quite popular funds. The one I saw was an extra 0.6%.
But
regardless,
it's not a Vanguard and passive index managers.
Yeah, they don't have Vanguard and index funds as yet. I understand they're coming. I don't know when.
Yeah, I mean, all the points you made, Alan, are right. Yeah, there's eagerly awaited their change to clear, transparent fees, no exit penalties. It has been pushed on, but it's came in now. There'll be a bit of a transitional period to it. They are the biggest by an absolute mile. I think for a huge firm, this is very transparent.
I couldn't agree with you more. I think, like, what's their stock price now?
Oh yes, the stock price has roughly tripled since it hit a rock bottom or whatever. So yeah, the market's quite excited about this new change.
Exactly. And I think all credit to them. And if you go back to the podcast where their stock price went down, I said, watch this space. These guys are making changes. I would be investing now in the long term in St. James's Place. I think it's brilliant. I think they've done everything really, really well and really transparently. I think it's really good.
It is insanely transparent. As I say, the large DFMs are just smoke and mirrors still in relation to fees. It's trying to get that from them is insane. They have launched an insanely low international equity fund, Carl, 0.09%. It's still classed as active, but the ongoing fee is insanely low. So I'm just thinking of that as a passive play. That's one of the lowest fees in the whole of the UK. So if a client is invested in that, which is 100% global equities, it's 0.8, 0.27 and 0.09, all in for 1.16. That's insane. And again, St. James's Place provide human advisors. The investment only individuals, DFMs, they provide no human assistance. So all in for 1.16 and getting a human advisor holding your hand, coaching you through everything, building you a financial plan. So I think it's a really compelling offering.
They're absolutely just changing. It's like the old guard is changing. We know a few of the players in there.
Existence.
They've had a whole clear out of some of the people who've been around for years, and so it's a bit of a gamble. I know there's quite a few senior advisors are not thrilled with everything.
I think the initial fees are still a little bit too punchy. I operate in exactly the same way as them.
You can discount them if you want to. It's up to you.
I'm just saying
maximum fees.
The headline initial fees I think are too punchy. But I'm not running a FTSE 100 business. I'm running little old me in a chicken shed, so I can take a hit on the initial fees. My ongoing fees are very similar. My overall fee that I charge ongoing clients is about 0.79 on aggregate across all the money I look after. My ongoing platform. Alan's is very similar. Don't be deceived, listeners. My ongoing platform fee is about 0.25, and my ongoing investment management is about 0.3. So it's on par, but obviously it depends on the individual you get.
Yeah. Everything eventually kind of consolidates around a particular fee structure. But the biggest challenge of all this thing, which is why it's impossible to compare apples with apples, is you don't know what service you're getting. We do full fat financial planning, comprehensive, etc., etc. And some are simply asset gathering, pension transfers, blah, 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 boring. and they're charging the same and or more. So it's an ongoing debate.
Devil's in
Nicholas,
the
is it? I heard a rumor that there might be somebody from SJP coming on as a future potential guest just to chat this through, maybe?
Not as far
Can you
as I'm
disclose
aware.
or deny?
Not as far as I'm aware.
Okay.
Give me the initial.
I thought you posted that online, but then again,
Yeah, and then the person you teed up said he didn't want to come on.
yeah.
So great.
But don't worry,
Thanks for that.
I got a replacement. Don't worry.
Yeah. He can't do the date that I said he had needed to do, so we're seeing him in January.
All right. Come
Okay.
All right.
on. Back end admin.
Thanks for the heads up, Nick.
Back end admin, yeah. Right. Are we done on SJP, or do you want to have another half an hour? Are we done? Okay. Kind of linking in with SJP a little bit. I had a nice email from a guy called Joseph Sykes. I'll read it out in full. Hi Nick, I was listening to the podcast on my way to a client meeting yesterday and wanted to echo the impact the podcast has had on me. You were talking about Max and how he decided to leave a practice and go his own way. I think that was via you, Alan, that particular story. Okay. I have a similar story. I was an advisor in an SJP partner practice. Don't get me wrong, it wasn't bad, good people, and doing a fair job. I had to say in the direction we were going. I decided to take the leap in May and set up on my own with valid path. There's never the perfect time. I had just moved house and my wife and I just had our first daughter in April. Bloody hell, Joseph Sykes, good man. Anyway, since listening, Trap has been great in helping me think about the service I want to give to clients and the business I want to build. Ironically, I started listening around the SJP episode, which I guess was the first one we put out, which is one of our most listened to episodes around the theme of SJP. So I just wanted to thank you for that, Joe Sykes, and wow, good man.
Good luck.
Yeah. Tremendous. Tremendous. Right, what's next on the slate? Wodge. Oh, this story. Oh, this is. Yeah, go on. Que sera, sera. Footballers. Sorry, footballers.
I saw this on a number of kind of news outlets talking about footballers. Danny Murphy, who's on Match of the Day, isn't he? And Brian Dean, and I think Rod Wallace. I was kind of interested in this because these were all guys who were playing when I was, about probably 20. But so a sad story about what's Andy doing? Anyway, a sad story about footballers getting caught out with kind of dodgy investments, or they claim to be dodgy investments, via a firm called Kingsbridge. The interesting thing about this is, it's not very interesting in that this continues to happen, especially to that era of footballer, it seems. Hopefully the guys who are looking after this niche are doing a much better job. We know some of them, and I know that they're doing great work. It's I don't know. There's part of me with this kind of going, like, some of the detail around the story is like, would you not have maybe asked a question or two? And but it just goes to show, the kind of herd instinct. If you get kind of one in a group, you'll get a whole bunch of them. And these guys were getting these footballers. So there's two lessons from this. If you're doing your marketing, niching works clearly because they all started talking to each other and they all loaded into this Kingsbridge firm, who I don't know if they did anything wrong. Just putting that on record. There are accusations of fraudulent behaviour, which I'm sure will come out in the court of law in the UK. But look, it's just sad, isn't it? Let's hope. There'll always be guys trying to pull strokes and put one over on investors who don't necessarily understand what they're getting into. But on the other hand, some of the detail, you're like, at what point do you go, hold on, can I just check, please? Or maybe get a second opinion from somebody. So, it's just an interesting story.
Ultra.
Probably because they're famous people and we know who they are. Anyway, sorry.
Yeah, this has been a common theme, and a lot of footballers have run into problems with investments. And there's a BBC programme on it. Annoyingly, I haven't watched it because I've been out and about. So maybe you guys watch that when you can. Apparently, an advisor I'm out with here, Keith Button, he told me about the story in a little bit more depth. One thing I'm going to raise on this point is we have legislation in the UK now about vulnerable clients. Now, I think young footballers, regardless of how rich they are and how much money they've got and how flash their cars are, they're insanely vulnerable. They might not think that, and then bringing that up with a 20-year-old strapping, wealthy, multi-millionaire footballer, but they're insanely vulnerable. Vulnerable clients legislation in the UK is infiltrated everywhere. But yeah, I just thought if anyone's vulnerable, it's Southern wealth from young footballers who often come from backgrounds where they don't have a lot of people that are smart around money. Slightly different to the rugby backgrounds, they often surrounded by people that they can bounce ideas off. As a massive generalisation, so they're insanely vulnerable, and I would like the vulnerable client regime to recognise that. So yeah, that's my
Yeah,
my
and I guess it's a difficult, lucrative, but a difficult market to operate in. So one of the advisors we know was telling a story, about a famous guy, 21, signed a mega deal, but he's dealing with his girlfriend, his father, his brothers, his sisters, that it's not just this one person, and there's people ringing and they're asking for money.
Yeah.
And
Hangers on.
It's a nightmare. It's a nightmare.
Yeah, that's difficult. Those boys earn their fees for sure. Even
one thing I take away. One thing I take away from that story is reading that story. If you're Joe Public listening to this, Civvy Street. If your advisor says, "Do you want to go on holiday with me?" That's a red flag. Okay, these guys these advisors in quotes. Is that in quotes? These advisors took their clients on holiday. That is a flag of enormous proportions, of a red hue, is what I must say. Smithy, your hand is raised.
This, unfortunately, is a kind of well-trodden path, isn't it, Nick? One of your favourite sports, the NFL in the States, and basketball, what have you, there are unlimited numbers. There is some horrendous statistic about, I'm just going to guess, it's about 70% of American football players who retire, multi-millionaires, become bankrupt. They just make bad decisions with the money. There's a few exceptions who become ridiculously wealthy.
But a lot of those players really do come from very deprived backgrounds.
Yeah.
I mean, properly deprived
but
backgrounds.
Unfortunately, and it's the same across most sport as well, you can see boxers and a number of other sports, and unfortunately it does seem to attract kind of people with unscrupulous ideas about what they should do with the money, and these people just they want to trust somebody, and somebody will come along and what would appear to be allegedly take advantage of them. So it'll be interesting. This is going to court, is it, Carl? The whole thing's going to end up with...
Yeah, I think they were outside. It was, they were doing a kind of demonstration march. Like, I'm like, oh man, just get a really good solicitor and take it to court, so...
Yeah, it's sad.
It's sad.
We would
sad.
say, and it's hard, but, word of mouth, as you said at the top of this, Carl, we do know a couple of excellent independent advisors who can deliver advice to them. But it's hard to find them, I guess, because these guys did go through word of mouth.
Mute, Andy. There's a lot of background.
Sorry.
Yeah, I think our lunch club Dirk is drilling into a bank vault somewhere in Cape Town, and there's also simultaneously being chased by a squadron of police cars.
It's the police with the straitjackets outside Andy's apartment banging on the door.
Good stuff. Okay, so I'm trying to segue into the next point, but it's very difficult. Northern Ireland Mastermind Ultra.
Oh yeah, this is just a bit of a shout out. Following on from Trap, and we've spoken about the Ideas Exchange in obviously London and the one in Dublin. They've set a Northern Irish mastermind up. Paul McCarberry is the guy that sort of runs it, and Stevie is another good financial advisor, runs it with them. They're actively looking for decent advisors and power planners and people in the profession that want to join it and they can add value. Paul's email is in the slate, apparently I'm calling it, which is the show notes, the so-called show notes. So if you are in Northern Ireland and you are of similar ilk to other fellow Trappists, then reach out to Paul and he'll give you the details about the meetup. So again, just a bit of a shout out for Trap. That obviously we've had a bit of a nudge for those guys to set that up. So yeah, keeping the good message going.
Best of luck to those guys.
Probably inspired by Wodge's example.
Carl, he did say, maybe mention to Carl, you'll do an all-island meet-up one time when both groups are established.
If they pay enough, they're more than welcome.
I think I mentioned it before as well. There's a group in Glasgow. Lisa Johnston is organising that group. I'm not sure.
Oh, is she? I didn't know she was organising
an initial meeting.
Oh, cool.
So it'd be great. I hope there's sort of Trap inspired mastermind groups all over the country springing up. I was with an advisor last week who was talking about that. Just really would love to meet like-minded people and just kick around thoughts and ideas.
If we could get our act together, we might be able to have a link on the homepage where you say you're interested in a masterclass and what area. So, yeah, leave it with us.
No, I think the first bit was right. If we could get our act together.
Genuinely don't underestimate this, because I would say it was transformational for our business when I met you guys and we started exchanging ideas. No, I absolutely genuinely
mean that. First time he's ever said that. It gives us zero
that's lovely.
credit.
That's lovely.
No, it's not. It's definitely not the first time I've said it. It was transformational because I had all these like doubts in my mind, and when I was able to just talk them out in our
and we magnified them.
Yeah. It was like, okay, there's other crazy people out there. That's good.
No, there's a load of value in meeting up with, sharing ideas and best practice.
Masterminds are the number one way to accelerate your life and career. It was in Think and Grow Rich, wasn't it?
A lot of it is just getting that stamp to say, that you're on the right track. Keep going, or stick with the plan. Just drive on. Yeah.
No, totally. Totally get with that. Okay, so there's a UK-based company called Calastone, and they monitor the UK fund market, the retail investment fund market. And we know that, what was it, back in April, that we had the Trump tariffs introduced and everything kind of went harum scarum, and the dying legacy media said this is the end of times. Well, after an initial flutter, the markets have resumed their very strong upward growth of the last decade or so, really, to an amazing degree. However, that doesn't seem to have much weight with UK investors. Now, I'm going to quote from this article that Calastone emailed me, and I'll put a link to it in the so-called show notes. I don't know whether these figures apply just to pure direct investors or advised directors and direct investors. But anyway, investors withdrew 1.3 billion from equity funds, up from 1.13 billion in July, marking the worst bout of outflows since the summer of 2022. Meanwhile, safe haven money market funds enjoyed their best month in 2 years in August. Investors added a net 633 million to their holdings. Fund investors are wary, clearly fearing a correction is round the corner. August was the third consecutive month of outflows, an unusually long stretch. Global equity funds were particularly hard hit. And there's some graphs in there as well and so forth, just showing that since January 23, every month since January 23, UK funds have had outflows, UK equity funds have had outflows, and now global equity funds are having outflows. This into the teeth of a rising market. So you've really got to work out what's going to happen as and when we do get some kind of temporary decline. As I said, I don't know if that's advised funds in there as well, but it's
Nick. I'm pretty sure it is advised funds as well. It's all funds. In fact, probably a significant part of that is advised. Portfolio managers, discretionary managers, etc.
Well, they've left millions and billions on the table then the last couple of months.
Of course they have, but they always do.
Yeah, I know.
Every time.
This is why we're here, isn't it? And they're going into money market funds just as interest rates are starting to come down and savings rates on those funds are tailing off from what were 2 years ago, pretty decent rates. Ultra, you're shaking your head. Is that shaking your head in just agony or disagreeing with me?
Oh no, sorry, not disagreeing with you. I'm just saying it's terrible the way that people react. So I agree with everything that you're saying.
Yeah. Yep. So
Calastone, is consumer sentiment in the UK driving a lot of that behaviour? Do you think? Genuine question.
It certainly is. It must be on the UK fund because, as I said, the UK equity sector has outflows month on month, bar 1 month since January 2023. Every month since then, there have been a net flows out of UK equity funds.
And it's been going up during that whole time, Nick, generally.
Yeah.
Steadily going up.
Oh, no, I know the FTSE, and not that you'd know it, is nine over through the 9,000 mark, isn't it? God knows how Paul Lewis sleeps at night, but that's another question. I don't know, Carl. I mean, everything is a bit negative in the UK, but that shouldn't affect how you invest in global equities. If you're projecting your downbeat view of your own country's economy on the world economy, aren't you? And that's nuts. The whole reason you have a global economy is that you're not a global equity portfolio, is that you're not really bothered what happens to your domestic market, because there's a whole world out there.
The numbers right now around what was kind of the Mag 7 and is now probably extended up to about 10 companies. They are driving. There's about 10 companies globally that are driving the majority of the returns. A lot of other companies are kind of going sideways, not doing a lot. But that's the point. We're in all of the companies. The ones that are going sideways, the ones that are killing it. We invest in them all.
I mean, our typical client's top holding now is Nvidia, as we know. You scroll down and you see it's top. A small amount of companies have always driven most of the returns and represented the biggest chunk of the market, but now it's slightly unprecedented. I think Nvidia represents 8% of the market on its own. So there's some odd skewing going on at the moment. But
those 10 companies.
What does Warren Buffett say?
Those 10 companies.
If you live long enough, you see everything in the investment market. So this is another thing that we've never seen before that we're seeing, for the first time. So
little fact: those 10 companies are greater than the combined market cap of all the European, not just the UK, all the European listed markets. 10 companies greater than all of them added together. It's mad, but hey, there we go.
Yeah, I'm just checking the global equity portfolio that I use with my own money and my clients' money massively, and Nvidia coming in at 2.5%. So even a
are they number one holding?
Yeah, number one. Amazon second, but it's not 8% or 9%. But they're still,
Microsoft the
smaller companies.
Yeah, that's right.
Yeah,
own 14,000 of the great companies of the world in one hit. Why not? Right, okay. Well, I'm conscious that we're at 46 minutes and we still got some more things on the slate. So quickly wrap through these. Smithy, Carlyle Group.
Just a quick one to acknowledge this. I found this is quite interesting. Intelligent Office, IntelliFlow, IO, whatever you want to call them, that they, we work with them, have worked with them for years. They are the dominant player in the financial planning kind of CRM, management systems. I believe they account for about 50% of the marketplace. I know a lot of people kind of moan about them. We've got a pretty good relationship with them because we understand how their system works. Is it perfect? Certainly not. Are they trying to improve? Yes, I believe so. I find this quite interesting. Carlyle Group, all of you will probably know to one degree or another, are one of the biggest kind of back to private equity companies in the world. Hugely successful company. The fact that they continue to...
Rubenstein, one of the founders? Yeah.
Rubenstein, yeah. He's and by the way, he's brilliant. The stuff that he does, the interviews that he does on, I think it's on Bloomberg or his own channel, but yeah, he's quite a player. And for them to come into the kind of the UK retail financial planning software market is quite interesting. So Carlyle Group have acquired IO. And this is just a personal view right now. IO seemed to me, like a lot of these organizations, are at a bit of a crossroads. AI has come in and has sort of stolen some of their lunch. We're all kind of trying to work out now, what does a CRM system actually do? Is it just a database of information, client data? Is it workflow? Is it, what the hell does it actually do? Because, they've got all these other players around them, whether it's Timeline, whether it's Saturn. There's a company called Ningi, which is, I've heard a lot about as well recently.
Planner.
And so it's just going to be quite interesting. They're obviously going to have some deeper pockets and firepower now at IO to determine their kind of their next move. But it's quite a pivotal thing in the UK financial services marketplace that someone so big and influential as Carlyle has acquired them now.
Yeah, I think it's huge news, Alan. As you say, 50% of advisors use them. Obviously, it shows that Carlyle think it's a wonderful business. They don't buy crappy businesses, so they see a lot of future potential in IntelliFlow.
Yeah.
And you're right, because all the other players circling and trying to work out what they're doing with AI and the future roadmaps, so they've obviously got a lot of firepower behind them now. But normally what happens in these situations, the fees start to increase over time as these private equity companies try and get their squeeze as much juice as they can. So yeah, this is huge news for UK financial services, but it's also quite a compliment that such a formidable brand has bought our biggest player in this space. So yeah, watch this space, it'll be interesting.
Okie dokie, good stuff. Moving on. Sorry, just absent-minded there. Email from my beloved, which is always a dangerous sign. Okay, wealth levies. Carl.
Wealth levies, that's me. Very, very briefly on this. You guys have spoken about the possibility of wealth levies and some stuff that has been introduced that high net worth guys are leaving the country. There's a little bit of talk about it again here. There's a very good article by Peter Kinsella on the danger and the minimal impact in terms of the amount of money that it would raise and the unintended consequences. It's a very well written piece, but the last his conclusion towards the end I thought was really good. It's like, okay, if you wanted to raise a shitload of money from the wealthy, means test children's benefit. So the people who don't need it don't get it. I've actually spoken about that before. It's so obvious. It is so obvious. And it's, I don't know, is it a political
We've already
football?
got that.
Yeah, we don't. So we
what do you call it? Child benefit, child allowance that everyone got, and then they completely smashed that. The previous government in the UK, Conservatives, dropped that. So we have got an element for children's benefit, but everything is so contentious. I mean, there's every kind of Western democracy is facing the same thing. Politicians, by definition, can't cut benefits. They don't want to. It's a vote loser. Taxes in the UK and a lot of places
they just choose not to. That's the difference.
They'll lose their job basically if they do.
Yeah, but look, there are challenges with it because that he didn't talk about. But like, if you're really, really wealthy and you're taking no salary out of your company, so will you still get it? Because it has to be done on net worth, and then how do you value companies? How do you value profit? So there are challenges with it. There's no point in saying otherwise. But look. Please don't let us start losing people to Malta and Portugal and all that kind of stuff. There's a few gone, but let's limit that. Anyway, we don't need to talk about it anymore. We've dealt with that one before. Thank you.
So, have you got your hand raised, Ultra?
No, sorry, mate. Put it down.
I was going to just mention something as a follow up to this, Carl, which is Daniel Priestley, keynote speaker at Humans Under Management London this year. Hey, Andrew. He's like everywhere right now. He's really raised his profile since he went on the Stephen Bartlett, Diary of a CEO. Saw him on the Trigonometry podcast.
It's my culture corner today, Alan.
What, Daniel Priestley on that? Okay. So, but he speaks specifically about this subject. And you would talk about it if you want later, but he just said, how do you value someone's wealth? If you've got a business, you've got an idea. In theory, it's worth 10 million, 20 million, 30 million. You haven't got the money, you haven't got the cash. How do you get charged? There's so many issues with it. But all right, we'll listen to Andrew a bit later on.
Yeah, it's a great episode, which I was happy to introduce you both to. Wrapping this up, storyteller.
Last one of the day. We did mention this is a kind of perennial issue that does come up quite regularly, I think, for all of us. I think you mentioned it in the last episode. Phil Bray's new venture to for those advisors who are happy to take on kind of perhaps lower revenue, lower clients, that sort of thing. I was reminded by my good friend Matt Pitcher of another similar network or group. This one is populated by those advisors who've seen the light and charge a fair fee, while not necessarily related to assets under management.
Yeah, you need to. You're on thin ice, my friend.
Yeah, I'm just. Don't shoot the messenger. But
0.95 a year, I think, for you.
So there is, but the good thing about this, and there was something that came up in the group this morning with Matt, which is some clients haven't got any money, but they really want financial planning services. For example, they might have property assets, they might want to self-advise, they might have just business assets, but they really love the idea of proper structure, financial planning, etc. So these advisors in this group who charge retainers, subscription, flat fee, call it what you will, fairfeeadvisornetwork.com, fairfeeadvisornetwork.com, link in the show notes. And if you are one of these enlightened, forward-thinking advisors that do not run a conflicted fee model, please check out the website and get in touch with Matt and join the gang.
What was your strap line? Flat fees for flat service.
Got it.
All right, let's go. 54 minutes in. Shoot me. We'll move on to the meat and potatoes of episode 79 of the award-winning Real Advisor podcast, TRAP Trap. So this meat and potatoes, as it often was inspired by the bit of content that one of us saw. I can't remember who put it in the WhatsApp chat first. Questions to ask a financial advisor, which came from the evidenceinvestor.com. Again, of course, linked to it in the so-called show notes. And these are questions that you should, if you're Joe Public, City Street, you should have front of mind when you're thinking about engaging with a financial advisor. I'm not going to say any much more than that because Wodge from Florida, from Pensacola, is going to lead off on this subject.
I am, yeah, because Alan found the article, suggested we read it. I read it. I said, that'd be a good meat and potatoes, and Alan went, great, you lead on that. So I got that message in Florida last night. So hugely prepared. It's an interesting article. It's a long read. It's an interesting read. Robin Powell puts out some great stuff. So I would recommend that everybody follows Robin for sure. I have a few pushbacks on Robin's article though. Andy, will you please mute? So he starts the article by saying that Vanguard, who have always extolled the virtues of transparency and that they're in it for the customer and all this kind of stuff, well, they were fined in the US because they didn't say that their private client division were actually getting paid bonuses if they onboarded new clients. So there was a fine of $20 million. So for a company like Vanguard, that's not actually a whole lot of money. I would say, I don't know because I didn't read the US regulator stuff, but it seems like a fairly minor kind of a compliance issue for them. My problem with that, but be that as it may, it's a fine, and they put their hands up and said, okay, we'll do it differently going forward. But Robin goes on then to say that, for me, he conflates the issue a small bit between the Vanguard issue about their advisors not disclosing, or Vanguard not disclosing that they pay their advisors bonuses, to he moves kind of into, well, and that's like the consolidation that's happening in the UK market with, the private equity guys coming in. And he points to, loss of independence if you're swallowed up by a private equity. That's an obvious one. Proprietary product pressure. So we kind of mentioned that earlier on about, you must go on our platform and you must invest in our funds and whatever. Fee increases. So they may happen. Those 2 points may happen about product pressure and fee increases. But that's not the case with all of the private equity guys. And then service deterioration. I don't know, like if you're flat out one man show with, kind of 2.5 people working for you, and then you go into a bigger firm, maybe the service will get better. So I'm just not sure about this whole discussion that's going on that private equity is across the board terrible. Now, when I said this something like this at Trap Live, and I got slagged about it, going, you're setting yourself up for private equity and blah, blah, blah. I'm absolutely 100%. I am not, but I'm not an idiot either. And I have had chats with people, right? And some of them are, well, yeah, we're in this for the long term, and you can stay on your own platform. And absolutely, we love your investment planning or your investment philosophy, and we love that it's financial planning led, right? Anyway, the three questions Robin says you should. So his conclusion are: how are you paid? And have you, what kind of bonuses, blah, blah, blah. That's number one. Have you incentives to recommend funds, right? So, yeah, okay, fair. And the funds that you're recommending I invest in, are you willing to invest in them yourself, okay? Now, my problem with this whole article, and there's another discussion on LinkedIn, is that business it's not binary. It's multi-dimensional. It's nuanced. There's so much stuff going on. And ultimately, your values are your values. Good behavior is good behavior. And misconduct is misconduct. So, there might be tons of reasons why you have decided to go a certain direction with your business. So, saying that every single person who has been consolidated, is that a word, right? So has been taken up by the Pac-Man that is the consolidators, right? Say that they're all wrong, that they're all only in it for the money and they've screwed their clients and whatever. I don't know. I don't get it. And there are lots of reasons for, people doing something slightly differently. And a lot of those reasons can be in your client's best interest. So I'm just pushing back a small bit on the black and white, and look, it's for me, guys, right? I have to say it probably comes more from the UK advisory market arguing on LinkedIn, right? I don't think it's a good look. And I think that there's very little allowance for the nuance of business. Like, why aren't you just like Ireland, where you just send a strongly worded email directly to the person who said something that you didn't like, right? So I'm referencing John's email.
Do you think that
John
doesn't
came
go
back
on
to
as
me, by the
well?
way.
Do you think that doesn't go on as well?
Well, I think that's more business-like, and it's more professional to say, hey, and then you can have a private discussion. But like going so hard in on, comments on LinkedIn, and I don't know, does anyone else want to talk about the Abraham LinkedIn message? Or maybe I'll go there, right? Because I don't really mind saying this. So Abraham talked about an article that Brian Hill put out, and it was all about the consolidators are exactly like what Robin has said, that they're putting pressure to go onto their own platforms and into their own funds or whatever. And then there was a guy who came back and went, well, I'm kind of one of those, and for loads of different reasons, that's not really the case. And then there was another guy coming saying, oh, you're, really aggressively, that's terrible and whatever. And I just, like, if clients are looking at that, it's not good. It's a little bit like the footballer story, right? The financial advisors have screwed these people with really bad behavior. That's in the media. And then they're looking at LinkedIn and the financial advisor going, no, you're wrong and you're terrible and your business is terrible. I just think it's not a good look. And I think black and white is not certainly the way my business is run. Like we have probably 70% of our business on a platform, but the other 30% is somewhere else for a reason. And it's for the client's best interest reason. It is not for our benefit, because we're absolutely clear that they all pay the same. But to say that, oh, that's terrible, Mellors Ireland don't have all their business on their platform, that's terrible. That's just not the case. And making accusations online about people's business without knowing the intricacies of what goes on behind the scenes, bugger off. Mind your own business. Look after your own field. Don't be looking into my field and saying, oh, that's terrible over there. So that's my meat and potatoes for today.
And by field, you actually mean physical field, don't you? Not.
We're Irish. We love our land.
Exactly. Stick over there. Not general area of expertise, yeah.
Alan, your hand's raised.
I think that was from last time, but I will go. I'll remove it. I just do that to annoy you. Carl, I think just listening to that, I think there's two aspects of this. One is the kind of subject at hand, which, as I read it, it's advisor firms selling their business to consolidators, and then having the assets gathered, consolidated, put on the clues in the name, consolidator, having it sort of streamlined, systemized, etc. And the other thing is really about this kind of online infighting within the profession. And there does seem to be, I don't know, from what I see, or maybe it's just the algorithm sending it to me, there's more than there used to be. There's always been a bit of sort of back and forward, active, passive, the obviously SGP questions. I thought we'd kind of progressed more as a profession. Seems that maybe we haven't. And there's one or two usual suspects that are forever being quite negative. I'm a solutions type person. I'd rather someone come up with, here's some thoughts, here's some ideas, rather than this is shit, this is terrible, you're all a bunch of crooks and criminals. That doesn't really help anyone. And I think you're right. I know for sure that some of our clients do read LinkedIn and they see this kind of back and forward. It doesn't look great. It's not a great look. So I would encourage people maybe to be, by all means, having a healthy debate, expressing your opinion. Absolutely nothing wrong with that. You can do it in a professional way, and I think you should be thinking about what your solution might be, rather than just say this is bad, this is terrible, you are doing the wrong thing. You can spin it to be more constructive and more positive, and encourage more people to do that. This specific subject that you are talking about is exactly. There's a couple of points. One is about incentives. Right, and so Vanguard were fined for effectively for not disclosing that their advisors were incentivized, and the other is more about the idea around consolidating everyone, and broadly often fees can go up within an in-house consolidated kind of investment solution. It's just weird. I mean, we've talked about this before. There seems to be this real reticence around selling The idea of selling. People do need to be incentivized one way or another. I'm assuming that we're all running compliant, highly regulated businesses. If there's anything untoward going on, if people are doing anything dodgy, and by the way, we have to, if I remember correctly, we have to submit returns to the FCA, our regulator, about those things, about incentives. Are people incentivized? Are they paid any more for certain types of activity, for selling certain types of funds more than another? All that sort of thing. So it's pretty transparent in the UK, and the information is being disclosed. And I think if that was being done wholesale, assuming that these organizations are submitting their data correctly to the regulator, they'd be in and sort of kicking the tires and having a look. I'll throw something just briefly out there. On my other award-winning podcast. The episode that just went out, there's a guy.
Is that still going?
Mate, it's just it's bigger than this one now. And there's my conversation with a guy called Phil Hollingdale. I don't know if anyone knows Phil. He's a kind of serial fintech entrepreneur. He's behind quite a few of the kind of financial services businesses in the past. I just loved the conversation because he is all about selling. You talk all his various stories and iterations of how he started these businesses. I said, how'd you get going? He said, I picked up the phone, made a few cold calls, sent a few cold emails, and guess what? He said multi-million exits. He sold his last business to NatWest for nearly 200 million. So he's done all right, but he just kept coming back to selling. And so I think just to remind ourselves, selling is not a bad thing. It's
selling is human.
You do have to be a little bit careful about incentives if you're overly incentivizing specific. If you get incentivized to sell like a private equity fund in this, to sort of join the dots between the previous conversation and everything else, then that might be up for question. But no, there's nothing wrong with selling. Be aware of incentives and sort of driving particular narratives. And the last part is, Carl, you're right. I mean, Rob Stevenson was on this podcast a few episodes ago. Rob knows the market. I speak to him reasonably regularly. There's a wide range. There's something like nearly 200 potential acquirers, consolidators in the UK right now. There's loads of them. And within that, there's a full range, like there is for everything. There are some that are very acquisitive, and they will pay top dollar. If you want to sell your business for an absolute fortune, you can do. But it is conditional on you moving into these. It's not rocket science. There are funds, there are platforms, there are portfolios with lots and lots of healthy margin built in. You move your clients onto those, you'll get a higher payday for that. All of us have got our kind of deal breakers, things that we would never do should we ever choose to sort of step away or sell. And I think just need to be quite careful of these kind of broad brush strokes. Private equity or consolidators are bad and you should never do it. So I think it's a fair point you raised, Carl, and I think it just needs a little bit more thoughtfulness and interrogation around specific circumstances.
Okay, I'll throw in a couple of points. The Vanguard thing, that must be specific to financial services, a company having to disclose all their internal incentivization structures and who gets paid more for what and who gets promoted. I don't think that affects all other industries, but obviously they breached the rules and they've paid for that. The consolidators are huge in the UK, as you say, close to 200. Pretty much every firm selling is selling to a consolidator. What is also quite interesting, if you're selling your firm and you're finding a like-minded firm to sell to, that's step one. So if, let's say, I sold my firm to a business that I highly trust, they're going to look after my clients, that's step one, then that business could sell to a consolidator that I don't like. So the second order effects on here are not simple. The final thing I was saying, the consolidator and the funds, what is happening is consolidator buying tens, hundreds of firms, and then there is some level of incentive and pressure to put them through in-house funds. That might be financial, logistics, again, business is messy. I don't know if the FCA are going to come after that at some point in the future. It sounds quite cushy at the moment. These companies are doing it, an X percentage of the assets that they look after in in-house funds. I'm sure the regulator will take a look at this somewhere down the line. So they're going to work out
I think they are doing already. I think they are doing.
Okay, I haven't known that they've done it specifically looking at that, but they'll want to work out if people are getting value from it. My final point is, in business, we're all conflicted. It's just a case of trying to minimise and manage those conflicts. There's so many moving parts within it, and sometimes we make decisions that might seem based on one reason, but there's another reason for it. So it's a hyper complex problem. So a couple of points. Nick, over to you before Alan, I'd say.
I don't really have a lot to say around this subject, to be honest with you. A couple of things.
Whoa, Nick.
There's something wrong with your mic, Nick. You're using the wrong mic
very,
now.
very,
so
very
you just
loud.
go quiet for a minute, Nick, and sort it out. Over to you, Alan.
Yeah, that previous comment, that 3-star was well earned.
It's been a shit show today.
I just give a further thought. A couple of things. Any sale is usually done via an earn-out, and that earn-out, so you'll get a chunk of money up front, and then you'll get some further payments year 1, year 2, year 3, possibly, and that will be conditional on not losing a ton of clients and not really damaging the business. And again, I think the laws of commerce and business, we've been on the positive receiving end when some firms have sold out to big consolidator, and this is where I think things go wrong. Is where the client who's been looked after by kind of independent, boutique-y, smaller firm get bought up by one of the huge organizations, and it's like financial planning by numbers. You get this service, you get this person, the whole, and there's not a lot of flexibility around that. You get this portfolio, and that's it. And so those people say, I'm not loving this. I loved it when John was looking after us and used to have a chat and a cup of tea and all that sort of stuff. And so they do then seek smaller independent boutiques such as ours. We've certainly picked up quite a few decent clients in the last year or two when this whole consolidator thing carries on. So I think you'd be quite naive to sell your business where maybe half of your consideration, the amount you're going to get paid, was conditional on your clients basically being happy, not moving away, because you'd be you wouldn't receive your full payment. So no, I think we're all big boys and big girls. We're commercial. We'll make our decisions, and we will all always do what's in the best interest for our clients and for our teams.
Just the final few points on this, right? My point about Robin's article is that there are two issues here. When clients come into Meadows Ireland, if they don't know or think that the private client managers are incentivized to onboard new clients, right? Well, is that not totally obvious? Yeah. And we disclose all of the fees, so we're hiding nothing here. So I didn't see a big deal with the Vanguard thing at all, and I think it's a totally and utterly different situation or scenario to consolidators telling people you must go onto our platform, you must go into our funds. I'm sorry, Robin. I thought you conflated two issues that were totally and utterly different, and that's my point.
Just on that point, Carl, I think in the Vanguard situation, they specifically broke the rules. The clients might have assumed there is some incentivization in the background. That's how business works, but it's the way that they didn't disclose it. So that's why Vanguard got the fine. It's because the way they did it. So there must be a law or a requirement that says they have to disclose it. Again, I don't really know the Vanguard case well enough. I don't think either of us do, but I think that was it. Go on.
Do you know, we'll keep this convo going as Nick tries to restructure his whole, hopefully he's going to come back soon and take over.
No drop.
But you know what, I remember...
Let's talk over each other, do loads of
whatever, shut up, mate.
Yeah.
Boo. Go on, Alan.
He's useless anyway. So I always find it really... You don't realise how far ahead that the UK is in terms of customer protection, consumer protection, and all the rest of it. Because in the US, and they talk about this word they always use called fiduciary. We've got fiduciary, responsibilities and what have you. Yeah. And there was a thing I remember. Was it Trump 1.0 or previous to that? It was this whole thing, and we're going to bring in this law, which and fiduciary meaning you put your client's interest before that of yourself or your organization, and that got kicked out. And so, as far as I'm aware, as we speak today, the US financial services, financial planning industry does not have to put the client's interest at first. Now, that is kind of 101 where we are in the UK, and I think it's maybe probably the same in Ireland. I don't know, but we have to at all times put our clients' interests. It's this sort of treating customers fairly. It goes back to all that, and now we've got consumer duty. Yeah. So the US rules and regulations are a bit odd to me, and I was a bit surprised that Vanguard got fined, basically for not disclosing that their advisors got paid for onboarding new clients.
Just going back to a point you said a couple of points ago, Alan. You said you think people are naive. I think that's a bit too harsh of a description, because all firms are basically selling out to consolidators and they have that similar structure that's been factored into it. So why are you thinking they're naive? I mean, these are financial planners. They're money people. They understand.
I was saying
how the deal's structured.
Well, exactly. All I was saying, one would be naive if you kind of took took the shilling and just say, I'm going to move my clients to something which is going to be far more expensive for them and an inferior experience, an inferior service, because the chances are a fair chunk of clients will probably vote with their feet.
Sure. If the service is
fire
a lot different.
that company, because the original founder and owner of that business is probably no longer around. So I just think I'm not saying they are, but you probably are naive if you think you can sell out to something where the fees and costs become more expensive. The service is inferior to what they've previously been expecting.
Sure,
and half of your money is going to come down the line and is dependent upon most of those clients staying on board. So it's a tricky thing to balance. Fortunately, none of us are selling out anytime soon, but it's worthy of consideration. But I think your point there, Carl, was there's a conflation of two different things, which I think is a fair point.
Yeah,
the Vanguard story is by itself. We've tried to spin it into this thing about people
infighting
selling
on
out.
social media is another subject. I mean, I used to do quite a bit of it. Now I've grown up and matured. I do very little of it now.
The infighting was about this Consolidator, and it's all shit and whatever.
It's whatever topics their hot topic of that time. Yeah, it's often active, passive, SJP.
I'd love to know
flat fees.
these people. Where do they get the time, and why do they think it's a good way for them to expend their energy to go online and go? Because I guarantee you, they're spending all day then looking. Did he reply?
I'm thinking that so many IFAs are on, and especially LinkedIn. I don't see them. Not that are accountants, are lawyers? Are they all sort of having
LinkedIn
digital punch-ups with each other all day long?
Oh, sorry, I don't know about the infighting in another profession. No, I don't come across it. No, I only come across infighting within the profession because someone said to me, Nick.
Right, Nicholas, are you back?
Are you back in the game?
I hope so. I can't.
Oh my God! No,
it's not sounding good, Nick. So
okay.
minimal
Just
interaction.
give it a go, Nick. Give it a go anyway.
Let's wrap this whole thing up.
Nick, do you want me to do the question, Nicholas? Let me know when you want
There's
to.
a lot of
fire
words,
away the
Andrew.
question. I can read just about.
just carry on, Nick. Well, you've got a contribution to this subject, the meat and potatoes, no?
Yeah.
No,
Nicholas,
not really.
what's your thoughts?
It doesn't particularly interest me to a great degree.
All right.
Okay.
My Lord. There was us
question,
defending
Nick.
our sort of sound quality production, and it's all gone pear-shaped. Oh, here we go.
You absolute grumpy bollocks. Oh my God.
No, it's just not a subject area that I find particularly interesting. It's okay not to have an opinion about some things.
Well,
We'll
I mean,
move on.
for the listeners.
The one thing I would say about if you want me to say one thing about it, I think having gone through RDR and really cleaned up our profession, this thing now kind of double dipping through the back door where you get these firms who are potentially pushing clients into their own in-house portfolios where they take a second slice. You're obviously going to an active route to do that because you're not going to put them into your own passive funds because you're not going to undercut HSBC, are you, with their global equity tracker coming in at 5 bips or something. And I think that I don't like that. But that's what I've got on it really. The bitching thing, yeah, of course you're getting more UK advisors bitching than Irish because they're about 10 times more advisors. That's just a volume thing.
Yeah, correct.
Right. Trappist question. Somebody read it out.
Wrong.
It's one of the factors, Carl.
Yeah, we don't do it. Anyway.
Okay, yeah,
All right,
interesting.
Andy, can you read out the Trappist question?
I think Nick has a bit of infighting online. Let's hear from him a bit more about this.
Oh, here we go.
No, I don't.
No,
not really. Not really. All the people I used to fight with on Twitter have left. Now it's not a left wing.
They've all blocked
Now it's not a left wing voice piece.
You're just fighting with yourself on Twitter.
I do that. I've got various accounts and I scribble and I block and I mute and I unmute.
Guys, get your phone out. There's an option on Twitter to work out how many people have blocked you. I'd be very interested in your numbers, Nicholas. I don't know where it is.
Andrew, I think you're on thin ice, matey, with that. Okay, I'm going to read out this question from Tom Oates because I've opened it up in the background while you were wittering on. Tom Oates has put his LinkedIn profile in. Thank you. So this is came across this article on Barron's with Christine Bell from Morningstar. Interested to get the Trap Pack's thoughts on the following, which I pulled from the article. Excuse me. The stock market has had a spectacular run in recent years. Do retirees need to adjust their portfolios, and if so, how? I'm a big believer in the bucket approach, where you set aside 7 to 10 years of portfolio spending in cash and bonds, including short-term or intermediate-term bonds or high-quality funds. You want to ballast against an equity shock. For many retirees, this will often be close to a 60-40 or a 50-50 type portfolio. A challenge these days is getting people who are about 5 years away from retirement to de-risk their portfolios. It isn't unusual to encounter older Americans with all or 80% of their money in stocks. That is probably too risky. Now is a good time to de-risk. It isn't too painful to take risk out and lock in some income by shifting into bonds or CDs, end of quote. And then Tom closes off saying, Lick, you have spoken before of the buckets, but 7 to 10 years of spending set aside seems overly conservative, as well as de-risking 5 years away from retirement towards a 50-50 split. Yeah, that's kind of lifestyle, isn't it? God help us. A great podcast. Keep up the good work. Okay, well, I'll go quickly first on this one. Yeah, 7 to 10 years of potential spending that seems excessive. It's this art over science thing again, isn't it? If you want to completely de-risk yourself from volatility in the frightening stock market, you'd put the rest of your life spending into bonds. But the trouble with that is you're going to encounter the bigger risk, which is your money will get eaten alive by inflation, and you'll probably outlive the money, and that's very suboptimal. Typically, I go 2 to 3 years worth of not spending, and again, I want to clarify this, of planned withdrawals. If you've got a client with a lifestyle of X, but they've got 2 state pensions, maybe a rental property, maybe a bit of a DB pension for a job they were in 20 years ago, okay, and then the planned withdrawals are just the difference between that and their lifestyle costs. So 2 to 3 years of planned withdrawals from that part I put into a short-dated global bond fund. Funnily enough, most of those portfolios end up in the round then in retirement are about 90-10, 80-20. Some are 75-25, some are 70-30. It all depends on what the planned withdrawals are. But I don't start off and say, you need an 80-20. No, we'll put 2 to 3 years worth in the pot, and then you'll just ride with it. And God forbid, if that pot runs out and you're still drawing down when the markets are having one of their temporary declines, then we'll have an adult conversation about maybe reining in spending. Let's just be real about this, right? The whole thing is ambiguous. It's very uncertain. We're just trying to mitigate against really unpleasant outcomes. I think 7 to 10 years, that's a 50-50 portfolio in a 30-40 year retirement is not going to do anybody any favors. Guys?
Yeah, my brief response on that is we've been fulsome in our praise of Morningstar in the past, and the content that they put out is generally very good. I think some of these organizations, there's only so many subjects, and they've got to keep going over and over and over it again, and then put a different spin on it, different something else, because this, what was it, a podcast or something?
There's the Christine, I think it's Christine Benz actually is the latest.
Yes, Christine Benz, who's generally pretty good. Listen to a few of those things, but this is just way too generic. This is the beauty, and we keep on repeating the same thing. It is highly personalized. Financial plan. It concerns me that Christine Benz is using the word 80% in equities is too risky. Define risk. Just define risk. Do you mean short-term volatile? Is that what you mean, or do you mean the risk of running out of income in your later years of a 30 to 40 year retirement? We keep on repeating the same old stuff, but unfortunately, it's because these articles and these podcasts and things keep coming out. It's highly personalized. Circumstances are different from client to client, different economic backgrounds, knowledge, experience, any number of other things, and therefore you can't say yes or no. I did mention on a previous podcast episode with a guy whose name escapes me now, and he had a grown-up conversation with his clients and said, how many years of planned withdrawals, expenditure, would you feel comfortable with holding in less short-term volatile assets? And the average was about 3 to 4 years, which gets you always end up roughly about 80%, funnily enough, in growth assets.
It was that American advisor, Alan. I think it's one of the best questions you can ask retired.
Yeah,
I think if you had to ask them one question when it comes to finances, money, and investing, I think that's the one question.
Yeah, you say to them,
give you the most insight you need.
Yeah, so you go back to what we say at the top of this conversation, like the dimensional charts and what have you. It's not if, it's when. There will be a temporary drawdown in your overall portfolio value, and during those times we would ensure that your ongoing income requirements are funded by less volatile assets. How many years? Because these things can last 2, 3, 4 years in extreme circumstances.
And the rest.
how many years do you feel comfortable with? And as you say, there's a bunch of other levers you can pull. You know, can you tighten your belt a bit? Is it discretionary expenditure? Is absolutely essential expenditure?
If you had to ask
and you
one
get
question,
and you
it'd be
go
that.
back and forth with the client, and you end up at 3, 4, 5 years. Sometimes you certainly don't get 10 years worth. Or I've never seen that.
Just
before.
closing on this. I mean, if you know, in the UK, if you had de-risked 5 years ago, say gone from 100% equities into 50-50, 5 years ago, you were going straight into that storm that was coming down the line when interest rates were recordly raised, bond prices fell off a cliff, and you'll still be sitting on losses, whether you're in short-dated, long-term, index links, whatever. So you didn't actually de-risk. You added risk to your portfolio, and you added purchasing power risk as well. You had both the risk. You had loss of value and loss of future purchasing power. The worst outcome you can have for a portfolio.
And the other risk that nobody talks about, low returns. You just put yourself in a low returning portfolio. It's again another sign.
That's what I was getting at with loss of purchasing
inflation.
power, Andrew. But yes,
No, that's inflation.
Right. Well, yes, but if you've got inflation and low returns are a problem if you've got inflation.
They're two different risks. But let's move on.
It's the same thing. Culture Corner.
There is a podcast, we've mentioned it before. I know Andrew has tuned in. There's a podcast called My First Million, Sam Parr.
Really good.
Another guy. Really like it. I kind of dip in and out of it, but really like it. They're kind of building up their media empire, these guys. They've got this organization called Hampton. And there's multiple other sub-podcasts, if you like, that these guys run as part of their group. One of which is called MoneyWise, the MoneyWise podcast. And they do talk to people. They kind of get into the weeds of what rich people do with their money and what the kind of personal investment strategy is. And I've listened to a few of them. There's a general negativity around financial planners. Why would I hire someone to buy me index funds? That kind of narrative that comes out. Good. And they had very recently a guy on who was exactly that, who was a financial planner in Calgary, Canada, of all places, but really good guy. Rob, his name is. He was interviewed. The host of that podcast, Harry Morton, is an English guy, and I think he records it from the UK. And Rob, the financial planner, is out in Canada, and he just really went through. I thought it was a really compelling conversation, and his sort of promotion of why you would consider hiring a financial planner. The guy, Rob, the financial planner, is a dimensional advisor, and he talks about dimensional specifically and why their strategy, their approach could well be better than just simply buying slavishly an index fund. But he talks about a whole other bunch of reasons, and it's just quite interesting listening to it. So the host of the podcast comes on saying, look, I hear you, but I'm not really, I need to be convinced, and everyone I've spoken to when I've hosted and asked people are not convinced it's worth hiring a financial planner. By the end of that hour or so, he's saying, you've convinced me, maybe I should explore it or listen into it. So it's called MoneyWise. It's part of that stable of podcasts, very highly professional, well produced, good quality, good sound quality, unlike this one. And it's well worth tuning in. If you're looking for sort of reasons, and if you come up against people who say it's not worth me hiring a financial planner, you get some good insights from Rob, the financial planner out in Canada. Thank you.
So what's it called again, Alan? MoneyWise.
It's called MoneyWise. I think there's more than one called MoneyWise, but I'll put a link in the show notes.
I'll find it.
MoneyWise, part of the Hampton group of podcasts.
The guy that runs My First Million, he's doing a live mastermind meetup in London, and they're looking for business owners at the moment. Yeah, it's quite
Sam Parr.
Yeah, it's quite a high qualifying number, but yeah, check it out. I think you just about qualify.
Well, you'll be 3 million turnover minimum. So
yeah, you need to have an exit.
Some of us do that in our sleep, Andrew. Next.
Sorry, you next? More than qualify. God, how dare me.
Speaking of which, I'll go next. Anyway, I don't have a Culture Corner because I have been, the last 6 weeks have been absolute torture, and I have literally done nothing other than have huge pressure with the triplets doing their leaving cert. So I'm guessing that you guys have something similar. Do you have the GCSEs or whatever? Anyway, I'm not sure if it's as pressurized there, but the pressure that the kids are under here is absolutely insane. It's ridiculous. I was not prepared for the build-up of pressure for my kids. Obviously, then the pressure comes into the house, and it's tricky for everybody. Then they have to wait for their results, and then the results come out, and then they have to wait for their university places. And we have had. That's why I had to dash to Florida at the last minute to get Chloe over here. So I underestimated massively the stress. I apologize to every parent who said, "Oh, I've got Johnny or Jill doing the Leaving Cert," and I was like, "So everyone does the Leaving Cert." So my apologies to all those people, and those of you who have yet to get kids through there, do not underestimate that. The second big one, right? Because this is a podcast about money. What they don't tell you when they say, "Oh yeah, it's going to cost," we increased at Metis the annual fee from 12 to 16 grand a year based on a study that was done. What they don't tell you is the 16 grand, at least half the cost is upfront. It's just, there you go, pay the money. I need to book my place to stay. I need to pay for the fees. I need to pay for the books. It is insane. I have never in my life actually spent as much money in a short period of time. Just go. So I'm glad this period is coming to a close, and best of luck to everyone who is kids who are about to embark on that final year. It is bloody difficult.
You do have three doing it at the same time, Carl. So you're allowed to feel that pressure. It's not one, they won. Three in one go is insane.
Yeah, it was a powder keg.
That's I guess the equivalent of A levels in the UK, I believe. As you know, my eldest has just gone through GCSEs, so he's now in the A level years, and so I've got that to look forward to. Thanks for the heads up on that and the expense thing as well. But I think that's a good point you make, Carl, in that we do advise clients, if you've got children who are younger or maybe much older and they've done this years ago, there really does seem to be an absolute, what we're facing, new technology and AI, and getting a good place in a good university is becoming increasingly important. So maybe a bit more empathy for clients who've got, teenagers going through these, very, very important exams. It's a fair point, well made.
Okay, let's move on. Well said, Carl. Ultra.
Onwards to me. So Alan alluded to this podcast earlier. This is the Trigonometry podcast. I think originally you introduced me to Trigonometry, Nick, and I've listened to more and more of their podcasts over the years, but they have got Daniel Priestley. And I've probably listened, the person I've listened to probably the most of all podcasts is probably Rory Sutherland. Probably a close second now is Daniel Priestley. And this year, Alan, you're right, he's absolutely exploded. I agreed to him to speak in about April, and since then he's just...
You'd have no chance if you asked him now.
Maybe wouldn't, yeah. So hopefully all goes well for November. So he's on the Trigonometry podcast. He's talking about how basically Britain is destroying its own economy. He's hugely pro-business, small government, backs the entrepreneurs. They're the job creators. He's all about money is now free to flow anywhere in the world. So if you make the incentives so terrible, people will obviously edit their behaviour, move abroad. He's a bit of a lone voice, or he's the best at articulating it. A lot of people massively agree with him, but they find it hard to articulate. But he knows all the numbers on the back end, like the average UK person is costing £18,000 is your tax payment. If you're paying more than that, you're paying more. It just goes into a whole amount of details. So it's definitely worth checking out. I learned quite a few new snippets. Listen to that show, so do check it out. It's quite long.
I love the fact he always comes well prepared. He just calmly says facts, data, evidence, information, versus some others who just ramble on and tax the rich or whatever else.
For example, unprepared, like this podcast.
Exactly.
That's why we should have called this ramble on, shouldn't we?
Yeah.
Well, we had to ramble on because you had technical issues today, Nick.
Well, this is true. I did. Okay.
Come on.
Daniel Priestley. I love him. Yeah. He's so good. Okay, so finally, me. A book I've just read, The Everything Store, Jeff Bezos and the Age of Amazon. Really, really good book. It did come out a while ago. It came out in 2013. But I think that's quite good because a lot of the people that were involved with Amazon at that time and the formation of Amazon in the late 1990s, their memories were still fresh, and it takes you right into the beginning of the of the story. He was still married to his wife then, and reading the book about from 2013, you have no idea what's coming down the line. Really interesting story. I actually quite warmed the guy. He's obviously very driven, and he can be very, very demanding of his staff. But he's such a visionary. This guy, he says that most businesses plan for sort of 3 to 5 years at most. This guy's got. He's from the start. He's had multi-decade ideas. They've taken time to germinate. It's well written. Some business books I just find them a bit taxing. This is well written. It's pacey. Amazon Web Services, AWS, is probably the most profitable part of the Amazon bloody stable now. And it came up almost as an accident. They were just trying to solve their in-house software problems, and they designed this concept. And now, of course, so many big brands use AWS. Good book, pacey, gets along, out of date, but I enjoyed it. And that's my culture corner. I think we're done, gents, aren't we?
I ordered something in Amazon last week about 9 a.m. in the morning. It was delivered to my home about 3 p.m. the same day. I didn't pay for any extra, any super duper thing. The same freaking day. I mean, you just cannot beat that level of service.
And it's often something obscure, like a hose pipe or something.
Some weird.
Why is that just hanging around the corner in Marylebone? Yeah, it's just weird.
Yeah, don't ask. Okay. On the assumption.
Oh my lord!
On the assumption that we're done. There you go, dear Trappists. As episode 79 slides down the U-bend of Father Time, it's time for us to say goodbye. And thank you for your precious time. Please do leave a review on your podcast app of choice. Probably will be iTunes, but other apps now you can submit podcast reviews. Like and subscribe to our burgeoning YouTube channel. Oh, please, jump. But apart from that, dear Trappists, it's adios. Take care out there. Goodbye from the Trap Pack, and we'll see you on the other side. Goodbye.
Woohoo! I did one from out of Ireland.
Well done,
Yay!
Carl. And Andrew. Bye.
Yeah, mega thanks to both of you. I mean, you, Carl, your head's all over the shop, and Ultra, you've got hum going on. So we do appreciate you doing it. Right, and we're done.
For the love of trap.